All right, so this week's going to be huge for earnings. This is the last full week before the general election here in the US. I got my vote in, mailed it in yesterday. Then I went and visited my 88-year-old mom and helped her fill out her ballot. She's going to be mailing it in tomorrow. So we'll see how the election sorts itself out. But I think it's going to be a couple of weeks of heightened tensions and I think a little more emotion generally in the news outlets. And I think it's going to cross over to financial markets because financial markets are going to be a little concerned that, hey, are we going to have a very close election that's going to be contested? Is it going to be uncertain of what happens? I would hate to think if there's any demonstrations or even violence that erupts, that would really be terrible. I hope it's not the case. I've got my fingers crossed that we have one more peaceful transfer of power, and we go from there. But as we approach the market this week, there's really, really good earnings that are interesting. I wanted to start with General Electric, which is a company that's really recovered, and I wanted to see where they're at in their recovery. And then we'll go over Duolingo and PayPal. Maybe we'll go GE, PayPal, and then Duolingo, because PayPal is a stock that I really watch closely and I also own. So let me share my screen. So General Electric historically was this conglomerate, and it had three big businesses. Its aerospace business, it had its healthcare business, it had financial services, and they were like the Apple 25 years ago, 30 years ago. It seemed like they could only do things right. And you fast forward, they had a tough, downturn. If you look at their max, see the max, here we go. So if you look at in their year 2000, boy, stock price was $300 a share, and they were still super valuable because we had the dot-com, bubble burst, and all stocks kind of got trimmed. And General Electric was really respected. It was a very, very valuable company. But then they had trouble, and their stock really sold off, and it really sold off starting around 2016. And fundamentally, the business was broken. They lost their mojo. They lost their, special sauce that they had, and it seemed like they just had a lot of problems. The good news is that the business did get repaired. Stockholders have done really well, but the company split itself up, and they have a business that does aerospace, a part of the business that does healthcare, and a third business, I forget what they're into, I think financials. And I'm going to look at the piece that just announced that just does aerospace and defense. GE does primarily turbines for aircraft, and the travel industry is doing great. They fill their planes, they're flying people around domestically or internationally. Things are looking really good for General Electric, for their aerospace business. And that's the piece that we're going to look at. The business has really flourished over the last 5 years. It's up 300%. So the market cap is really, it went from, call it 65 billion up to 194 billion. That's a big, big march. Go General Electric. And they did that mostly over the last, call it 2 years. So that's a really good return. When they fixed the business and they kind of broke it up and said, hey, let's focus on these primary businesses, that's what really enabled GE Electric, what is now primarily the aerospace and defense company, to really focus on that business and do well. Their revenue is 69 billion, so you're paying about 3 times revenue for the company. The PE is really high. The stock price has gotten really high. That is a high stock price. And analysts still think it's a buy. Now, they announced on the 22nd, and the market didn't quite like what they heard, and the stock did sell off. I've been looking at the stock, before we started the call, and I was forming some impressions about the stock. And here are the 3 different companies. They split the company up in 3 pieces. Healthcare. So if you can go to hospitals, you'll find their imaging equipment and so forth. I believe this is for financial services. Then this one here is aerospace. This is what we're looking at. So when I look at their financials, and I'm just going to stick to the stock analysis because I think they have a better layout. The company did repair itself. You could see a lot of red in the previous years, I should say. And now they're beginning to grow. So that's really positive. They're growing their top line revenue. Overall, I think that their valuation has gotten too expensive. The valuation of the stock or the stock price is much higher than what I think the intrinsic value is for the company. And one of the primary things that I would show is the free cash flow number. And this is somewhat of a very good number, meaning this is as good as it's gotten for the company in a long time. The trailing 12 months is 4.8 billion in free cash flow. Well, if you took the market cap that they're currently selling at and divided the market cap by this number, you get 40 times. That's a high stock price compared to its free cash flow. I would only pay that 40 times if it was like a high growth company. Like they're growing 80% top line revenue. They have a really special product that's disruptive, transformative. It's like a big addressable market where they're just going to continue to expand for the next 5-10 years. That's not GE. This is the aerospace industry. They're going to grow at a modest amount, maybe 5-10% going forward. I would really be comfortable paying more around 20 times free cash flow for the company, maybe 25. And that would put the company at like $100 billion valuation. But the company is valued way up at 193. So I think that the stock price has just gotten too high on GE. I have been a GE stockholder. Unfortunately, I was a stockholder way back here. And at times it was like, oh man, this is a great stock. This is like almost like being an Apple shareholder. And then it started to get ugly. And I'm like, oh my God. And then I still own the stock. And up until probably around this era, I started to sell it off and I haven't touched it since. They needed to repair their business. I do feel like I should have caught this because I know the company well. My wife worked at General Electric. She worked at the business that is now healthcare. So it gives me a little bit of insight on what the company does. She worked there for several years around this era. And anyway, so I kind of missed this move, but I think the stock price is way too high. It probably is going to settle down 50% is my expectation over the next couple of years. So this was a name that I thought was interesting to look at that announced last week. Now let's take a look at a company that Tomas wanted to look at, and that is PayPal. And PayPal is going to announce this week. Go ahead, Tomas.
No, sorry, I pushed by mistake, but I thought about PayPal because I kept thinking about you said about long-term winners, and I used your quadrant to analyze the stock. And even though PayPal does not have an entry barrier, it's not a monopoly or anything, it's a very solid and consistently used app for the people. So maybe it's a long-term winner, but I'm here to hear what you say about that.
Yeah, let's talk about it. So I think that so let's start on that note. So there's a couple ways of getting barriers of entry or moats, right? You hear other investors use the word moat. Like if you have a castle and you have a moat of water around that castle to keep your enemies from attacking your castle. Now, barriers of entry is more of what I was taught in my master's in business, and that's the term I'm going to use. So I put PayPal around here, and the piece that I really like about PayPal is that they've created a network, and there's a concept called the network effect. The network effect means when you create a network, people tend to stay on that network. So there's a lot of people using the PayPal network. For example, I've been a PayPal business customer for 16 to 18 years. And my wife and I own a business, and that PayPal is one of the principal payment methods that we use. And for a long time, we've been using it. So we're not going to move. And then they have Venmo, which is another network. They have people that use Venmo. They're not going to move. They have their friends on there. And do you have Venmo in Argentina?
No, we don't have it. PayPal is known as a easy method to bring money from other countries. It's very hard in Argentina to to bring any payment from other countries because of regulations. But through PayPal, you can do like a connection through Uruguay and then to Argentina. And it's Argentina is kind of a mess, economic wise, but we found our way through PayPal.
And, FYI, the reason we started using PayPal is because, the banking system in the US, it's got so much darn bureaucracy, right? Like it takes so much energy to pay people. And it's like, why does it take so much darn energy? I just want to pay somebody for something they did. So we used PayPal and it worked. And they would pay us too, by the way. So it worked. So they have a network and that network keeps customers in it. Now, they don't have, like we talked about pharmaceutical companies yesterday, and they truly have a patent. Nobody can use that formula. But I think PayPal, their barrier is their network and their brand. So I like that. So I do think that is a very desirable aspect to their business. Now, I put them a little bit in the gray here because they have to compete against, like Stone Co down in South America, or here in the US, you have Block, which is somewhat competing against PayPal. You have transactions on Visa, MasterCard, American Express. So in general, I like their business. And I especially like their business because when you look at the company over the past, like General Electric, let's talk about General Electric really quick, and I'll make a point and then go back to PayPal. So you can see that this business was discounted for multiple years, or I should say they were trying to fix General Electric for a couple of years. And then they finally got everything fixed, and then the stock flourished. It's up 300%. So when you look at PayPal, you're going to see a similar chart, but not quite where General Electric's at. The stock was really high, $300 per share. And people really liked the stock back in 2021. And now it's been sold off dramatically. I mean, at one point, it was sold off by 83%. But the business is not broken. They did have, maybe they didn't grow fast enough. The market didn't like it. Maybe there were some threats to their business that the market processed, but not 83%. That's just pretty ridiculous. So when we look at this stock, and I'll get to their valuation in a minute, I think there's an opportunity for that rebound and for me to invest at the right time and then catch that rebound. So far for the past year, it's up 50%. That's pretty good. And I think it's going to keep going. When you look at their market cap, they're 83 billion and their still PE ratio is 19. Now, what makes me comfortable about this business is see how they were growing in 2018, 18%, 15, 20, 18. They keep getting bigger. They keep growing. That's a sign of a strong company. If you keep growing your top line revenue, that means they're getting more customers. The customers that are already on are using more PayPal solutions and products. And all those things keep adding up and it keeps making the company bigger and more valuable. When we look at their cash flow, the cash flow has been there every year, positive. And the trailing 12 months is 6.7 billion. So this is a growing business. We just saw General Electric, their market cap, the value of the company is 40 times cash flow, 40 times. But here at 6.7 billion, and we look at the market cap for PayPal, we're at 83 billion, right? So if we divide 83 billion divided by 6.7 billion, we're going to get to roughly 11. Okay. Let me make sure. No, it's going to be more than that. It's going to be about 13 times free cash flow. So you see a very big difference when you compare PayPal. It's like, wow, they're a really discounted stock. I just saw General Electric. They're priced at 40 times free cash flow. PayPal is more 13 times free cash flow. So the company is going to continue to generate cash flow, put it on the balance sheet, buy back shares, maybe at some point pay a dividend. All those things are positive. So PayPal does have, I think, a good position in the marketplace. They're going to announce on October 29th. Other things that we need to observe with PayPal is the economy okay, right? Because if the economy is contracting, like, oh no, we have this bad recession, then fewer people are the amount of buying and selling on PayPal platforms is going to be lower because they're not going to buy as much. But the fact is that the economy is actually doing well in the United States. And I know, speaking for Mexico, the Mexican economy is doing well. Canada economy is doing well. And I think that PayPal is going to have a good 2025 based on the economy. So I'm expecting that the news is going to be good on PayPal coming up this week. Their balance sheet's in really good shape. Let me show you the valuation I have for PayPal. So on PayPal, I think that the stock is discounted by 47% because those cash flows are so valuable. This is where the cash that I showed earlier on the financials is showing up. And when you start, the forecast of cash flow means they're going to continue to accumulate all this cash in the future. And cash is king. Cash is what values companies. And when I do a net present value of all those cash flows, and really I can move this down to 8% because interest rates have dropped. The intrinsic value is just very high for all that cash. I add cash on the balance sheet. They have more cash on the balance sheet than they do debt. That's another sign of a strong company, right? If you don't have any debt, you don't have much risk to go bankrupt. So the company's just worth far more, and this market cap's not accurate. I think they were 83 billion. So update that. So overall, those cash flows is where I look at PayPal and make my decision that, PayPal is worth a lot more than its current stock price. It's probably going to go back closer to its all-time high, which was $300 per share. Right now, the share price is $81. If it could just get to $150 per share, that would be halfway back to its all-time high. Then I more than doubled my money, and I'm good. I'll be very good at that rate. So that's PayPal. Let me pause there and see if you have questions or anything you want to go into further on PayPal.
Well, for a time I was reading on PayPal any information I could have. And I believe that one of the problems before was the CEO, that he wasn't expanding the business. He was just in automatic mode, like just, okay, the company is doing kind of fine, so we don't have to make much changes. And with the new CEO, they are canceling inactive accounts, and they are focusing on only the accounts that are active. And I believe that is the goal of the new CEO, and to implement new features in the app, for business mostly, because they understand all the business that use PayPal for payments make the biggest income. So I believe that is the strategy. And I was buying any price below 66, and anytime the price dropped below that, I was buying. So
good job.
For now, I'm okay with PayPal, but now that I see your analysis, maybe I get some courage and buy a little bit more.
Yeah, well, I'm glad that you're sitting on good gains. Right now, I'm sitting on a 25% gain on PayPal. I've been invested, maybe call it for about a year. My dollar cost average in my investment, I own $64,000 of PayPal. I'm holding until after the election. Maybe I'm going to hold for the next 2 weeks and just sit tight. But at some point, I might start to buy more shares. I think 64,000 is a pretty good number for me. It's not a. I think it's a good stock. So I look forward to seeing their earnings, and then based on what they report, because I agree with you that the new CEO, I like what he's doing, and if he makes the right changes and they really start to increase their growth, and they don't have to go from 8% growth to 50% growth. If they just show hey, we went from 8% growth to 9% growth, the market's going to go crazy and the stock's going to fly up. I'm hoping that's the case. I double my money from this point.
Yes, because when you see the chart of PayPal, it looks almost like a Chinese stock, like super high at one point and then go down and never going back again.
And that's part of the opportunity, right? Because, the market, one thing that's incredible about the market is that it treats stocks in a way where it's very emotional, like Meta, right? For a while, the market thought, man, Meta's terrible. Meta's a terrible business. In fact, we're going to reduce the stock price by 76%. We're talking about Meta. Isn't that incredible that the market said, hey, this is a terrible business? we're going to sell it off by 76%. And although it was a tough year, 2022 was a tough year for a lot of companies, investors, and I did buy shares at this point, not all my shares. And from that point, it's up 531%. So if we can see PayPal come back to its, previous stock price, again, you look at the business and you go, okay, the market sold it off by 83%. Holy smokes. So what broke? What broke at PayPal? What's broken? Well, nothing really. The company kept growing their revenue. They kept making money in the form of profit, cash flows. Did they become unpopular? Yes, but that's an emotional, qualitative metric, right? The market doesn't like PayPal. Okay, that's one thing. Like it didn't like Meta because the metaverse didn't work. And then the market was like, oh, those guys are not a good company. Well, PayPal, they kind of went through a more extended negative perception phase, but the value stayed there. They continue to grow their business, generate profit, generate cash flow. Their balance sheet has more cash than debt. Having said that, I'm expecting that they will have a recovery like Meta. Now, it's not going to be as good as Meta's. I don't think. I'd be really, really happy if it was the case, but I think they're going to recover. And, the past year has been the beginning, I think, the recovery. They were at $300 stock at one point. And if we could just get back to $150 per share, that's halfway back to its all-time high. And we would double our money from this point, so fingers crossed that's going to be the case. How you doing, Brad?
So.
Good to see you.
Hey, good afternoon. How you doing today?
Really good, really good. We're just kind of in the middle of PayPal, and if you want to give it some thought, if there's any stocks you want to look at, I'll ask you in a few minutes.
Okay.
So let's see how PayPal announces. That is one stock that I've got circled, and on the live stream that I do following the 29th, I will most definitely cover PayPal and update my analysis. On on the valuation itself, a few things. I changed the discount rate, and because the discount rate, as interest rates fall, the discount rate on stocks, and this is why, like when you hear that when interest rates rise and then small caps go down in value, it's because of the discount rate. As interest rates go up, the discount rate goes up, and especially for small caps, it really reduces their value. That's why their stocks really go down. PayPal, I had it at 8.5. I lowered it to 8% because interest rates are falling. Okay, so just wanted to note that. All right, so the other stock you wanted to look at was Duolingo. Let's take a look at that. And can you refresh my memory? What does Duolingo do?
Yeah, it's Duolingo, and it's an app for learning languages.
Ah, okay.
I'm trying to follow your advice and focus on companies that I understand what they do, and companies that I believe they have potential. Duolingo is, as I heard you say, one-trick pony. They only teach languages, but I think they have a lot of things to do. They can have more languages, expand to many more countries, and do campaigns, alliances with schools, and so on.
Okay. So I understand. Okay, they do languages. Okay. The market cap's still fairly low, even though the stock price is doing really, really well. 185%, up 81% in the past year. Very good. Looks really good. Let's look at their growth. Growth is really good. So you have very good growth. And I'm going to look at the quarterly. Very good. Very good sustained growth. Have you used the Duolingo app?
Yes. I have been using it for 535 days because the Duolingo counts how many days you
Really?
use the app. Yes.
And what's your impression? Like, is it a very good experience? Is it an okay experience? Is it a bad experience?
It's a good experience because you will understand if you go to another country, for example, you will have a little but solid base of how to communicate. I don't think it's appropriate to learn the language, because they don't explain how the grammar of the language. So you have phrases, and it's based by memory learning.
But the structure, like kind of learning it properly, how do you construct a good sentence? It's different. Like English to Spanish, I'm bilingual, but I'm educated in English and I'm not educated in Spanish. But I do know that the way that you write and the way you express yourself in Spanish is almost opposite to English. And English is a little inconsistent. Spanish is very consistent. Like here we would say the red car, and we'd put the adjective ahead of the noun. In Spanish, it's flipped. We would go noun before the adjective. So
yeah, I get it. It's not explained at all, and Duolingo does not explain that, does not give you hints about that. You just learn the phrase, and you learn it, and you learn how to say it and what it means, but there's no explaining of why the adjective is before the word, and that I believe you will need a teacher for that, because Duolingo is not enough.
Yeah. So from a business perspective, you see how cash flow is 224 million for a young business, and them growing at 40% plus and generating free cash flow. That's why this stock's really moving up. Investors really like that. Like, so 224 for a business growing at 40%, right? I mean, I could see myself saying this cash flow, see how the cash flow went from like 14 million in 2020, and now it's up to 224 million. Wow, that's incredible. Let's look at their profit margins. So when we look at businesses, what makes a business desirable? Well, Duolingo sells, right? They sell $634 million of revenue. They get to keep $465 million just from a cost of revenue. What does it cost to operate the app? Electricity, servers, data center fees, and so forth. But that's it. It's not like you have to hire people to be communicating to that customer as they're using the service. You don't have to buy materials like a car and assemble it and then ship it out to the customer. This is a service. This is an intellectual property-based service that they're helping you learn another language. So where I'm getting to is valuable businesses have very high gross profit. Apple, Microsoft, Google, Meta, NVIDIA, they have high margins. And if we divide this number, 465 divided by 634, we're going to get to about 70%, roughly. And that's 70% margins. They get to keep 70 cents on every dollar of revenue. Now, they still have to operate the business and administer it. So you have selling administration costs. They have research and development and make more products or make their product better, operating expenses. So you don't get all this money. You don't get to keep all this money. You still have to administer the business. But this is a very important line to get our heads around. And this is why the stock's moving, is high gross margins, high cash flow. And if I took their 224, multiplied it times, let's say 50, I would get to about $11 billion in value. Right now, the stock is priced at 12.7 billion. That is an expensive stock. I would not be ready to buy this stock because it's priced up quite a bit. It's pretty expensive. If it fell down again to, like, not too long ago, in August, it was at $158 a share. Man, if this stock has a downturn, like if we were to go from 291 per share down to like 200 or 150 again, this would be a really attractive stock. But right now it's a little expensive. The other piece, the red flag that I would see is, how do you think AI is going to affect Duolingo? Because AI is going to be able to give us multi-language. That's going to be kind of pretty, that's easy to expect.
Well, I try to practice with Meta and ChatGPT and Gemini, and they can help you to learn a language. And what Duolingo, what it has is very well known to learn languages, and I think they will lean on the AI. and to make a case about that, like, okay, we are the biggest language learning app, and now we are using the best AI to get better at what we do.
I'm giving, oh wow, pretty cool. So I'm giving Meta the kind of test drive. How do I say what is the best school for science in Spanish? ¿Cuál es la mejor escuela para ciencias? That's it. Very good. Now, it even went further, so that's very good. Now, are these apps, does Duolingo, like if you were to ask something like this, would it actually have an audio example of it? Like say, well, this is how you would say it.
No, that is the you cannot translate phrases. They have a course for you. You start on level 1 and you keep growing your knowledge in the language through the course, right?
Are you practicing the phrases? Like, are you speaking into the app and then it says you said it right or you said it wrong?
Yes, that's correct. Yes. And the app tells you if you pronounce it right or wrong.
That's pretty cool. That's pretty darn cool. And I mean, that's how you're going to learn it, right? All right, very cool. Very cool. So, so this is it's a very, very interesting company. It's a lower cap. These lower caps can really move. I just think this one's really moved already. And I'd be afraid that, look at this move here from August 5th, it's almost doubled in stock price. And previous to that, it was kind of not sure it wanted to go up for a little while. And then it really jumped up in the last 2 months, 2.5 months. So I would not be ready to buy into this stock. This would be like a watch list stock. And I would say be hoping or expecting that at some point, see these jagged drops? At some point, it's going to give up some of that stock price. Okay. They're going to announce on November 6th. That'd be a very good earnings announcement to take a look at. But if it dropped down to like $200 a share, which it, it was there not too long ago, maybe at that point it might be a good buy stock. But right now it's a little expensive. Your thoughts?
Well, I think it's expensive too. Honestly, I didn't thought about buying Duolingo stock because I didn't know they were in the stock market. But because I use it every day and I took your advice about trying to invest in things that we know, so I take a look at Duolingo and I say, okay, this is good, but yeah, it's expensive. It's not like yeah.
So I'm glad you're doing that. And what I would encourage you to think about is you're doing the right things. Now, you found a very good business. That's a very good business. It's just priced really expensive. So let's wait for that stock price to drop and then we buy. Similar to like Meta, right? We know that's a good business and the market really sold it off a few years ago. It dropped and then buying was really good. And then we saw the stock go up 580%. That's a long-term winner. So this one here is a very good business. If for whatever reason the market gets a little scared of this stock and it sells it off and reduces it by 30-40% in stock price, that's the opportunity. Okay, so this is a good watch stock. Like I have my watch list, right? I'm watching all these stocks, kind of keeping up with where are they, like, and kind of see certain stocks I'm watching, and when it drops to a certain amount, like Union Pacific, I've been watching that stock for a long time. Once it gets to a particular discount level, I'm ready to act. And Union Pacific, I'm ready to act after the election. I'm not buying too much right now. So that's a good one. Interesting. Anything else on Duolingo?
No, for me, that's it. Thank you for taking a look on Duolingo. And yeah, I'm going to put it in my watch list and try to use the spreadsheet to see what is a good price for Duolingo.
Perfect. Yeah, good luck with that. And let's look at it on November 6th. It looks like it's going to announce. I don't know if they announce before or after the market opens, but November 6th is in 2 weeks. So in 2 weeks, we're going to get an update on where their growth is. And these kinds of stocks, right, smaller stocks, if they have any bad news in that earnings, this stock will go down 20-25% because it's a small company and it'll be a good earnings to look at. All right, good one. So Brad, I don't know if you had a stock or two that you wanted to take a look at. We've covered PayPal, Duolingo, General Electric earlier, probably we covered General Electric before you joined. I think you joined right in the middle of PayPal.
Yeah. So we touched on one a little bit Friday evening. I've been looking at HAFN, the shipping company.
Okay.
I've been deep diving those guys a little bit, and also HAL, Halliburton Energy.
Okay. Halliburton Energy?
Or Halliburton Company.
Okay, Halliburton, just the energy services company.
Right.
Okay, so Halliburton, and then the other one was
HAFN.
HAFN. So yeah, let's take a look at those. And for sure, HAFN is, I mean, it's looking good. I think the dividend was super attractive.
It was.
I mean, if you're just sitting there, like, I think we looked at the stock price, and this one hasn't been publicly available for a long time, but an investor might be like, well, you know, I'm afraid I'm gonna lose some value, right? And I would say, yeah, that's important to keep your eye on. But at a 26% rate of dividends, this stock is going to give you back your money in 4 years, right?
Yep,
if you invested $10,000 in 4 years, they're going to give you $10,000 back in the form of dividends. You're going to have to pay taxes on it, so that's a fact. But at that rate, you're like, even if the stock price went down to half its current value, I'm still ahead by 50% if you follow my math, right?
Yeah, that's true.
It's not a very bad downside. It's like, now we looked at how they can afford that dividend, right? So we're dealing with a $1.62 in dividends. That's each stockholder is going to get $1.62 for each share that they own. All right, well, can you afford that? Can you afford that, Hafnia? And when we look at free cash flow per share, $1.86. These guys are not dependent on oil prices. They are dependent on shipping rates. Oil prices are not, I would say, have been priced lower than typical. If oil prices are like $80 a barrel right now, I figure that's kind of like the midpoint for me. They could be a little higher, they can be a little lower. But we've been like in $60 per barrel prices. Right now we're in low 70s. And where I'm getting to is, if these guys can make these kinds of profits with an oil price that is, you know, lower than typical, I'm optimistic these guys are going to keep making money, because energy is not like, hey, no matter what, they need that product moved from Saudi Arabia to cold climate parts of the world every season, because those cold climates need to warm their homes. They need to run their factories. They need to do all these things, right? That's just a fact. Seasonally, that has to happen. So I think I'm expecting that this company is probably going to operate around those numbers. The one thing that I would say is, you know, let's try to figure out, you know, what's been causing their growth, because they are growing. Go ahead.
The one thing I found is they added to their fleet by issuing shares and buying more ships. So how does that affect the balance sheet when they do that? So instead of putting out cash, they just issued shares.
Well, I think that's smart. I agree with it. And the reason that I agree with it is, you know, when you issue out shares, if you're issuing out shares to make the business bigger fundamentally, in this case here, right, they buy ships and they put them into service, and then those ships are going to start generating more revenue. That's like acquiring another business. Okay, I'm okay with that. At a certain point, you know, you have to make sure that the business isn't buying too many ships, and then they have too much supply of ships and not enough demand. But I don't know if they've gotten there. These are the ships that they operate. Okay, so let's take a look at investor relations and take a look at those financials and see what we can glean from those financials. So consistent dividend payout. So they're really focused on the energy and chemical industries. And when you look at the global economy, right, like here's one of the it's maybe just an example. I'm not sure that they need oil because they have their own oil, but one thing that I've noticed is like Mexico, their economy is really growing and doing well because the United States would prefer to near shore. They instead of their supply chain, being so dependent on China, the United States prefers to near shore, and automotive companies, appliance companies, and so forth have factories in the US and they also have factories in Canada and in Mexico, right? Well, when you have that type of big change in the global economy, these energy companies start delivering product to those countries that need the product. And Mexico has their own oil, but maybe they need other chemicals that need to be brought to their ports. And that's where this company comes into the picture. And I'm sure China is using these in a big way because China doesn't have enough oil to run their economy. And if China's going to grow at 5%, they're going to need a lot of these ships to be delivering product. India, I believe, is in the similar boat. India's economy is really growing and they don't have like oil. So they're probably making deals with Saudi Arabia and Iran, Iraq, the oil producing countries, and having that oil shipped via shipping vessel over to India. All right, so let's crack open the financials and see what we're going to find. And before doing so, let's look at their presentation. That kind of will get my head around their business, and then we'll look at their financials, the details. So they're profitable. So one thing that I'm curious about is where do they get their shipping rates? Like what shipping rates are they having to, charge their customers? Okay, so they're profitable and they pay a big dividend. Okay, unparalleled investment opportunity. So this is where we talked about like can they afford that dividend? So they're paying out a portion of their profits. So that looks good. So remember that Red Sea conflict with some of the ships being attacked that were going through the Suez Canal? That's what caused some of these shipping rates to go up, or at least instead of them going through the Suez Canal, they had to go around the tip of Africa, and that causes for longer voyages and more fees for companies like these. I think this is where they're tracking it. The Cape routing, you see that how that part of the graph really expanded.
Yeah, I do.
So that's why their revenues really went up. And I mean, I'm not a geopolitical scientist, but I heard that like North Korea sent troops to partner up with the Russian troops in the battle against Ukraine, right? Was that going to create more instability? I don't know. It's not helping. It's probably just going to create more tension. So here are the volumes. Volumes are going up. These guys provide really good information. Yeah, these guys are tied to the Suez Canal, and all the conflicts in the Suez Canal are what are driving more longer voyages and higher fees for them. Their order book looks good. So product tanker outlook remains very positive. So it looks like they can get more ships to expand. Okay. So here's their total income. Really expanded compared to last year. So look at the return on invested capital. Wow, 29%. That's like really, really good. This is very good. Return on equity, 41%. Why is this? So part of my like a little bit of disbelief is like, why does this look so darn good? What am I missing? What's your feeling on the stock, Brad?
I mean, I'm the same way. I haven't found anything that tells me not to invest in it, and I have taken a small position in it. And the stock price has been dropping the last 2 weeks, and I don't really know why.
Yeah, I mean,
and I put it in the model, and the model tells me that even discounting it like 13, 14%, it's still
you're still again,
I still can double your money, and
it's risk reward, right? Like,
yeah,
we're all taking risks. When you buy a stock next week, you know, the company could have a class action lawsuit that's they're going to have to pay out $10 billion. That's the risk we're taking. We don't know that.
yeah.
But the reward on this case here is like they're paying a massive dividend. It's like you're getting your money back. So,
I mean, I think I actually discounted it like 13%, and I just did growth of like 3%, and it still look good.
yeah, they IPO'd recently, right? They IPO'd in November. Yeah, they IPO'd June 3rd, 2022 is when they IPO'd. And from there to here, I mean, you're a winner multiple ways. If you bought back when they IPO'd, you your stock's worth 74% more, and you've been paid these massive dividends. So you're doing really well. And they are, where are they located?
Well, they just moved. I noticed that they are now going to be in Singapore.
Yeah. Well, that's kind of one of the hubs to shipping.
Yeah.
Yeah, I mean, and you said their stock's kind of moving down, right? 7% year to date. Yeah. Go ahead.
If you look at it for like the last 5 days to a month, it's steady moving down.
Yep.
So
now with smaller stocks, right? I don't bet the farm.
Yeah.
I'm careful with it, but I still invest. I invested in Zim. I invested in symbol PANL. And FYI, both of those investments were a windfall for me. I'm just a little bit scared because I'm like, small company headquartered in Singapore. What if one of their oil? So it's not. I'm not saying that I wouldn't invest. I might invest. I'm kind of putting it in the category of it's a very positive investment. But what prevents me from going up to like a $50,000 investment, right? This would probably be like a $10,000 investment, kind of limiting my exposure, maybe moving it up to 20,000. Like on PANL, I moved my investment, and part of it was because the stock kept appreciating. At one point, I owned like $60,000 of that stock. That stock was tiny. It was the market cap is less than $1 billion. But I just kind of took a very measured approach. And these guys have a specialty in the way that they moved cargo. They only use, they have ships that move like gravel, cements, kind of aggregates, dry aggregates. And they have to move them to really awkward places like, hey, we're building a dam in Alaska. And these guys are like, okay, we're literally the only company you can use to move that product from some port to the port, destination port. So they could really maintain really good shipping rates. So the stock really moved nicely. It paid a nice dividend. I bought at the right time. I bought like down here, owned the stock, built the position up. I kept putting money into it because it kept going up. And I'm like, geez, that's great. So then I sold and pretty much either doubled or tripled my money. And I'm like, okay, I'm good. I can move on. And went into Zim later, did well with Zim. And right now I'm not in a shipping stock. So I'm like, is this one maybe the right one to get into, or should I go back to Zim? Should I go back to PANL? There's opportunities out there. I'm just always like trying to get in and get out without getting hurt. And I've been good so far in the shipping industry. I got in PANL, got in for Zim, got out, made money. But I'm sure one of these times it's not going to go as well. This one here, I would think is a good investment. I just wouldn't put a ton of capital into it for me, for my portfolio.
Yeah, I agree.
All right, good one. And then Halliburton, I'm familiar with. And Halliburton does fracking. I believe the symbol is HAL. And I think politically, it doesn't matter who gets elected. They're both saying that, hey, fracking is going to be a part of the energy plan for the U.S. Halliburton is a fracking company. That's where they make most of their revenues. What's interesting is look at the stock price. Man, it's really down. Yeah. It's a really small cap. Last time I valued Halliburton, they were discounted really nicely. So they're down 30% in the year. They pay a small dividend and $25 billion market cap. I like Halliburton more than I like Schlumberger. And because of this market cap, you look at their market cap, you're like, man, that's really low. Schlumberger is much more expensive. And these guys are focused on fracking, which, like a lot of the oil in the US is in this shale or sand, and you need fracking to extract the oil. And politically, it's kind of a green light to that particular process of extracting oil. So that's good. Why is the stock price moving down? Is probably oil prices, right? We have, let's see here. I can't see oil prices there. So this is oil prices for last year. We've been kind of, for the last, from July we're in the 80s. Now that's a very good oil price. And they really went down in the month of September. They got down to 65 per barrel. Now they're up to 71. You can see that, we've seen higher oil prices just in the last 12 months. And when you get these higher oil prices, Halliburton's going to rally because it's going to be recognized that, hey, the fracking activity is going to be much higher because oil prices are higher. So it's not a bad time to buy Halliburton. Not a bad time. I think I'm watching Halliburton. I'm currently not watching it. But I can tell you Halliburton does value quite well. If we look at their free cash flows, they're there. So 2.3 billion in free cash flows. And when we look at their income statement, they continue to grow. The market is like selling them off, but these guys keep expanding, getting a little bit bigger. So if we look at their free cash flows compared to their market cap, the company is going to price with a good discount, like 20 to 40% discount. I agree with like these analysts, not quite as optimistic as these analysts. They're basing it on earnings per share. And they're expecting that, hey, this company is going to do far better than people are expecting. So this is a good opportunity, Halliburton. I'm getting out of Chevron, not completely. I just own too much Chevron. I sold some shares last week. And I'm trying to do that because I want to diversify. And it's great to have Chevron, but I'm thinking buying like a smaller player like Halliburton is a good idea. And maybe even Hafnia, because Hafnia is involved in the oil complex because they're moving energy from one market to another. So those two are going to be stocks that I follow. And as I lower my position on Chevron, I'm going to move to put a smaller player into the mix. Right now, my only energy company is Chevron. I own $99,000 of it. I'd like to get that down to like 80,000 and then buy a different energy company to diversify within the energy sector. So two good ones. It's just, the good news on Halliburton is the market's discounted the stock. How further down is the market going to sell off the stock? I don't know. Is it going to start to rally, pretty soon? Maybe. I could say that if the Republicans take the White House, this stock's probably going to rally because they are, it's no secret, right? They will be like, hey, drill, baby, drill. Let's crank out oil, create jobs. Let's get going. And Halliburton will probably rally. So I would say that if Republicans win the White House, you're going to see Halliburton rally. Now, the Democrats did say, we're not going to stand in the way of fracking because they know that it's really important to jobs. So they're not going to be, completely on board with the whole, hey, let's drill, but they're not going to stand in the way. So I don't think it's like a big risk that if the Democrats win, Halliburton's going to really be punished. No, I think they're just not going to be as popular as if the Republicans win. Boom. Like, hey, Halliburton's going to rally because it's the Republicans tend to be more, let's really extract as much oil, create as many jobs out of the energy sector as possible.
Is Pump similar to Halliburton?
Yes. Pump is smaller and they are very focused on fracking. And they too have seen their stock go down. It's tiny, less than $1 billion.
Yeah, right? I can tell when oil moves up and down, then Pump just, if it goes up, it goes up. If the oil comes down, then Pump just really comes down. It's really volatile.
Yeah. And the official, this is hydraulic fracturing. And I believe what is commonly referred to as fracking. They pressurize the ground and kind of think of squeezing a lemon for the juice. They squeeze the oil out of sand. They squeeze the oil out of shale, and the oil gets extracted. They use a lot of water too, which is, just kind of stating the process, right? They use a ton of water, which the EPA is uncomfortable with because they're like, geez, man, we don't have enough natural water, for drinking. And then we got fracking companies that use a tremendous amount. And once they use it in their process, humans can't consume that water because it's polluted. You die. So that's just part of the process. I had a client here in Bakersfield, California. This is exactly what they do. And they kind of educated me on the fracking process. So you're operating in spaces that I think the market is neglecting. And once those stocks start to work, they're going to pay back investors. That's, my philosophy is try to buy when nobody wants to buy it. And then when everybody realizes it's a good investment, then you make a lot of money. Wonderful. That's part of my recipe, right? Yeah. I hate buying when everybody likes the stock. Like we looked at, I think it was Duolingo. That's a great little business, but everybody loves it. And the price is really high. It's like, well, I don't want to buy when the price is high. I want to buy when the price is low. Yeah. So good discussion. I wish you well, and just keep bringing it up. Let's keep tracking it because I think you're looking in places where the looking is good.
Quick question for you. I know you invest in Pfizer, and I have a position in them too. What do you think the earnings is going to show? You think we're going to have a uptick, or you think we're going to continue the downward?
I think it's going to rally. I think it's going to go up. And why do I feel that way is the past is so darn bad that you can't get any worse. And when I say the past, right, like, so a big part of the market is comparing to what you did, right? That way the market says, oh, you grew 10%. Oh, you contracted 5%. Well, their problem is they were a victim of their own success, temporary success. They had this COVID vaccine period, and they more than doubled their revenues, pretty much overnight. Boom, boom. And when you start comparing to this, so you had 2023 comparing to the biggest year in their history. So when you're sitting there going, oh, I'm sorry. Well, hey guys, like everybody knows COVID's over. We're not selling vaccines anymore. So our business contracted 41%. Investors can't put their heads around that. They're like, oh my God, this is a terrible business. I'm being overly dramatic, sorry. But the way that I'm using my common sense is, well, let me compare them before COVID, right? Even before 2020, they were a $40 billion business. Fast forward after COVID, they're a $58 billion business. They're $18 billion bigger. Well, they were probably doing some things right. Okay, they're bigger. Now, they also have some acquisitions that are going to begin to work and begin to drive that top line growth. Now, that's just annually, but let's look at quarterly. So when we look at quarterly, they're beginning to grow. Okay, because Q2 is comparing to Q2 of 23, and that number was already normalized to the post-COVID business. So when we get to the earnings this week, I'm expecting this number is going to be 10 to 20%. And when the market sees that number, the stock's going to go up 10, 20%. That's my amateur, that's my expectation. That's what I think is going to happen. It's not a guarantee, but that's the story, or that's the logic that I'm following.
Okay.
I'm going to be, of all the earnings that are happening this week, this is top 3. And if this number starts to improve, I'm going to take my investment in Pfizer and I'm going to double it as fast as I can. Right now, I'm at 36,000. I'm okay getting up to 100,000 on Pfizer. But if the stock starts to work, I'm betting big. So that's Pfizer. And I think they announced, when did they announce? They announced on the 29th. So what is that? Is that Tuesday or Wednesday?
It's Tuesday, I believe.
And they announced before the market opens. So I'm going to live stream on Tuesday morning. And guess which company I'm going to start with? So if you can't make it, no big deal. Listen to the recording. This is the one that I'm going to take a look at. All right. Good stuff. Thanks for tuning in, Brad. Tomas, thank you so much. And you guys, I'm going to go ahead and land the plane on our call. If you need anything, just shoot me a message on either email, or if you want to use any other messaging, go for it. And then for sure, I'll be on the live streams, and then we'll connect next weekend as well.
Sounds good.
All right, guys.
All right.
Hey, thank you.
You're welcome.
All right, thank you.
You guys take care.
Yeah, you
Bye.
too. Bye-bye.